There's many different types of life insurance, and if you sign up for the wrong one, then in 5, 10, 15 years, when you finally realize that you signed up for the wrong type of life insurance, it could already be too late. I just talked to a woman earlier today that thought she was signed up for one type of policy, but was actually signed up for another. And as you probably know, you're the youngest that you're ever going to be again right now. Next year, life insurance is going to be more expensive. Whenever you realize that you're in the wrong policy 10 or 15 years down the road, it could already be too late. In this video, I'm going to break down the 3 main types of life insurance and what they are, the pros and the cons, so that you know exactly what fits your needs. And ultimately, we get life insurance to protect those that we care the most about, whether it be a spouse or our children. Having the right policy is extremely important because you don't want to put their well-being at risk if, God forbid, something happened to you. First type of policy that we're going to talk about is called a term life insurance. It's probably the one that you're most familiar with. If you've ever rented an apartment or rented a house before, then you know you get to temporarily live there. Every payment that you make to that house doesn't go to building any equity, and then when your rent is up, you get the option to renew your rent or your lease at a lot higher rate, especially in this housing market where prices and rents are skyrocketing. Whenever you think term, it's like renting a house. You're not building any equity or what's called cash value in life insurance, and it's not a matter of when you die, it's if you die during that time. Whenever your term is up, usually they're 15, 20, 30 years, you can renew, but it's going to cost a lot more. A lot of times it's 10 times more or even more than that. Term policy's bad? No, I actually have a term policy on myself. It's not the only policy I have, but they're very beneficial, especially if you're younger and healthier. They're the cheapest in terms of the premium. They're the hardest to get qualified for, and you get a big death benefit if you die during that term. But there's another type of policy that we're going to talk about now called a whole life policy. There's a lot of misconceptions about whole life policies that, quite frankly, I bought into before I started learning about it, and this is actually why I got into the business. A whole life policy is more like owning a house instead of renting it. A whole life policy is going to cover you for your entire life. The premium's always going to stay the same, and then every payment that you make goes into 2 buckets. It's split up into 2 different buckets. One is the cost of insurance, and then the second is what's called a cash value. This cash value is like your equity in your house. Whenever you make your payment to your house, some of it goes to the interest, and which is the cost of the loan. The other goes to the equity of the house. As time goes on, you build more and more equity, and you can use that equity for home equity lines of credit, stuff like that. And the same is true with a whole life policy. The more cash value that you get, more you're going to have to use later down the road. And that's a big benefit with these policies, is that you can use the cash value without interrupting the growth. In a whole life policy, it can grow annually anywhere between 2 to 6%. Just depends on the company and how it's structured. Not all whole lives are equal. If you want to take advantage of the growth, you want to get a specific type of whole life policy, and you need it to be designed a certain way. When Dave Ramsey talks about these whole life policies that agents get paid tons of commission on and you don't get any cash value for years, those are not the type of whole life policies that I do for myself. I put a certain amount in, and then within just a month, I was able to access almost all of my cash value. Did the same for my daughter's policy, did the same for my wife's policy. By the way, guys, if you want to learn more about how these policies work, I left a link down in the description that you can check out to learn more. Now, the reason that most agents don't do that, quite frankly, is because they get paid more if they don't. It's almost a give and take. If you have more cash value in your policy sooner, then the agent has to make less commission. They want to get paid the most commission. As in terms of the insurance company, they can't allow you to have a lot of cash value really quickly and pay the agent a high commission. It's a give and take. Make sure if you get a whole life policy, it's designed right. And again, remember, the main purpose is the life insurance for your entire life. Premium's always going to stay the same. It's not a matter of if you die, it's when you die. Whether it be when you're 60, when you're 80, when you're 150, if you live that long, you're going to have insurance. And the third type of policy that we're going to talk about today is something that's actually really popular, and it's called an IUL, or Index Universal Life Policy. It's similar to the whole life, where it covers you for your entire life, and it's similar as in the premiums that you pay, a portion goes to the cost of of insurance, and a portion goes to the cash value of the policy. That cash value you can use. One con with the IULs is usually whole lives have quicker access to cash value, and with IULs it can take a little bit longer to build up. But one of the pros and what a lot of people like about the IUL, a lot of people are switching to the IUL as a 401k alternative. They're ditching their 401ks and going into IULs is because the cash value grows according to the stock market. If the stock market goes up, your cash value goes up. Now, it has what's called a 0% floor, which is really unique in this product, meaning if the stock market goes down, you don't actually lose money. Your cash value doesn't go down. You can't say the same thing with a 401k. If you had a 401k and knew anybody that had one in 2008 and 2009, you'll know that when they looked in there to retire, especially those that needed to retire, there was almost no money there. There's 35, 40% or sometimes more gone from their 401k. With an IUL, you get to take advantage of the growth of the stock market, and you also get to eliminate the downside, really, because if the stock market crashes for whatever reason, you don't take those losses. On average, the stock market has performed over the last 10 years about 11 to 12%, but you're probably sitting there thinking like, Casey, there has to be something with this product. It sounds too good to be true. And there are some things that other agents won't tell you because they're just primarily concerned with selling the IUL. Now, it doesn't make it a bad product, but it is something that we need to know about. The IULs are complex. Cash value follows the S&P 500. Every year, whole life, your cost of insurance stays the same every year. It doesn't matter how long it's in effect. With an IUL, your cost of insurance will increase slightly every year. Now, don't get cost of insurance confused with premium. Your premium contains the cost of insurance, but also contains the money that goes to the cash value. With an IUL, if you're looking at the historical returns, then you should have more than enough cash value to pay that. But you got to know the risk that what if the stock market goes down every year for the next 5 or 10 years? The odds of that happening are probably low, but you got to know that it's a risk. Now, if you're somebody who's wanting to use your policy, your cash value policy for infinite banking, the whole life is the product that you want to use if you're wanting to do infinite banking. Just a disclaimer, we would get paid more selling you an IUL. We have no incentive to switch you to whole life. It's not like we get paid more to do it. That's just the reality. If you want to learn more about infinite banking and how that works, then I made a whole video about it here. So make sure you check that out. And until then, I will catch you later.